Hi, thank you so much for joining us. I'm Grace Cavantis, and I have with me Mike Eklund. And today we're going over Financial Symmetry's July 2023 market update. As a quick note before we dive in, the information we're going over today is not investment advice. It is for information purposes only. So please keep that in mind. And with that, Mike, would you like to get us started with how markets have done so far this year?
Yeah, thanks, Grace. Yeah, it's been a strong year for the stock market through June. And as noted on the chart on this page, looking at the performance of US, international, real estate, and bonds over the last year, and that's from July 1st, 2022 through June 30th, 2023. You see US and international stocks have done very well, up somewhere between 17 to 19% for that time period. Emerging market stocks not as well, up over only less than 2%. Real estate has been down, and then the bonds suddenly have been down as well, negative 1% approximately, given the rise in rates over that time period. Although I will say that bonds have been doing much better this year so far, as rates have not changed quite as much as they did last year. So, and then also on this page, you can see information on the last 5 and 10 years of the different markets as well. But the reason why we wanted to show you the last year versus the last quarter was we thought this was a good time to kind of remind folks, where we were a year ago. So a year ago at this time in June of 2022, the stock market was down about 20% year to date. There was talk of obviously the Ukraine war had started, inflation was high. There was all these reasons not to invest. But what history said, when the market goes down about 20%, the next year returns are about 18.6%. Well, what happened over the last year? The returns are about 18.95%. So it just kind of shows you. And we'll have a couple more slides on this. Sometimes the best times to invest is when it's most difficult, when there's all these reasons not to invest. And this last year was another example of that. So with that, I'll hand it off to Grace, who will talk a little bit more about inflation and what we're seeing and what's happened over the last year with that as well.
Yes, a year ago, inflation was being talked about everywhere, whether phone conversations or the news or just everywhere. And that's because it got really high, up to 9.1% year over year a year ago. But fortunately, as markets predicted, it's come down to 3% more recently year over year. And this is due to the Fed increasing interest rates.
Yeah, Fed increasing interest rates. Yeah, obviously we had the post-COVID increase of spending that has kind of slowed down somewhat. And then the joke always in the financial community is, the cure for higher prices is higher prices. And that's kind of the joke in that, those higher prices has resulted in more competition, which has, dropped prices as well. So that is the good news, that inflation is at a much lower level than it was last year at this time.
Yeah, we're hearing about it a lot less.
Yes, very few questions on inflation compared to last year at this time. But another slide which we thought was helpful to provide folks was something that BlackRock published in the last quarter, just talking about how investing with emotions can be costly. And so what this depicts is, on the left-hand side, it shows in the orange bar your 3-year returns if you invest kind of when everyone else is investing. In the 20 months where the most people were investing in the S&P 500, your return going forward for those next 3 years was about 5.5% per year versus the average of 9.5. So effectively, buying when everyone else is buying didn't do as well. But actually buying when most of the people are pulling their money out, so the 20 quarters, I should say, where the largest outflows from the S&P 500 occurred, the returns over the next 3 years were 13.9% per year. So, this is called following the herd is the first one, which is not great. And then going against the herd is the second one, which obviously is much better results. So once again, the goal is to return, is to be buying when others are nervous and trying to sell.
Yeah, going against the herd can be really difficult as well. And I think that's the value that an advisor often brings to investors. So to follow up on this slide.
Before we jump forward, Grace, that's why the title is Investing with Emotions Can Be Costly. So that's why it's important to have a process and a rules-based investment strategy.
I also think it's interesting, based on that previous title, that some of the most intelligent and I think not emotional people I know, when I look at their investment patterns, there is a lot of emotion still sprinkled in there, even though those are the people I would think least likely to do that. So following up on that slide, we've seen that decades of research show that most investors invest based on what they see has done really well over the past 1, 3, 5, and even 10-year periods. And unfortunately, that doesn't tend to work out well. For example, right now, if you look at the past 1, 3, 5-year periods, the S&P 500 or US companies look like they've done incredibly well. But Vanguard's projections are predicting for that to not be what we see potentially going forward over the next, let's say, 5-10 years. They're showing that the markets with the best opportunities looking forward are small companies and international companies. So it's completely the opposite of what we've seen over the past decade, but that is what is projected by Vanguard and other big research firms to be doing well going forward. And Vanguard is also showing that markets that are the most expensive are US companies, and particularly large growth companies and high yield credit. So that's something we want to keep in mind and have had to continue reminding ourselves and our clients of lately, when it feels like, why wouldn't we want to be invested entirely in US large growth companies? As a quick reminder there, Financial Symmetry's investment strategy is currently focused on international and small companies for this reason.
Yeah, and this is another reason why diversification is so challenging but so helpful, because it's so easy to chase what's done well. And as always with diversification, the challenge is there's always a part of your portfolio that you're not happy about. And that's how you know if you're diversified or not. So this is a reminder not to kind of, put all your eggs in one basket, or in this situation, folks focus on only one area of the global investment markets. With that, we get near the end here. The one thing we've talked a little bit about what's done well lately. We talked about kind of chasing the trends, kind of has been the theme of this quarter. But one of those trends over the last 10 years has just been large US companies. They've done very well. Investing, just in the S&P 500 has been a great investment in the last 10 years. It's not always the case. During the 2000s, the S&P 500 actually had a negative return. But this slide, what it is from Vanguard as well, which I thought was very helpful, it kind of compares the US versus international stock performance the last 10 years. They actually predicted, 10 years ago for international stocks to outperform US stocks. And unfortunately, as we've seen, that has not been the case. But what has been driving that? Many would say that's 100% due to better US companies. They grow faster, higher earnings, higher dividends. That's why they've had better results. But the actual results have been different. The reason why US companies have outperformed international the last 10 years has been people have been willing to pay more for them. So that's what's called the valuation expansion. People have been paying a lot more for $1 of earnings of US companies than they were willing to pay 10 years ago. So that's about 5.6% of that outperformance. The other 3.6% on this slide is foreign exchange. So that's just saying the dollar has strengthened to a very strong dollar situation. And so the combination of that and the willingness of individuals to pay more for $1 of earnings of US companies has been the primary difference between US stocks and international stocks. So if you think that's going to happen for the next 10 years, you kind of have to bet that these two factors are going to continue, that people are willing to pay even more for US companies than they have in the past. And in addition, the dollar is going to even get stronger than it has been recently. So that's a tough bet. That's why we think at Financial Symmetry, a more globally diversified approach is better for you on a longer term.
Yes, to quickly wrap us up, if you have questions about Financial Symmetry's 3-step investment process, please reach out to your financial advisor. And if you are not a Financial Symmetry client, you can reach out to us on our website via the Talk to an Advisor form. Also, if you have any questions, feel free to reach out to me or Mike or your advisor. And on the screen, you'll see our email addresses. Also on our website, we have a blog, podcast, and we have a YouTube channel as well. So there's a lot of information there where you can learn more about us. Thanks for joining today.